Stop ignoring Chinese AI stocks. Seriously, if you're only focused on Nvidia and OpenAI, you missed a staggering 500% gain in just 5 months. The counterintuitive truth that many Western investors have overlooked is that MiniMax, a Chinese AI company, is growing at an explosive pace. In just 6 months, their enterprise and developer clients soared from 200,000 to 1 million, a remarkable 5-fold increase. They now boast 300 million users globally and over $150 million in annual recurring revenue, which has doubled in just 2 months. Although they reported a net loss of $1.87 billion, most of this was due to accounting fair value losses rather than operational expenses. Since its IPO in January, the stock has skyrocketed by 500%, and on June 5, MiniMax will join the Seng Index alongside Zhipu AI. For years, I ignored Chinese AI companies, thinking they were too risky and politically charged. But then I discovered MiniMax's impressive metrics: 5-fold client growth, doubling of ARR, and a remarkable stock surge. I realized I was overlooking the second largest AI market in the world. Today, I'll guide you through MiniMax's achievements, shedding light on their million clients, vast user base, and how the losses reported aren't as alarming as they seem. Let's dive into the numbers, which are nothing short of astonishing. MiniMax now serves 1 million enterprise and developer clients, a dramatic increase from 200,000 just 6 months prior. The global user base has climbed to a staggering 300 million, and their annual recurring revenue now exceeds $150 million, doubling in just 2 months. In the year 2025, revenue stood at $79 million, marking a 159% growth year-over-year. It's essential to note that while in the West, we marvel at OpenAI's $25 billion revenue, MiniMax is scaling even faster when comparing growth rates, an astounding 159% year revenue increase, and that ARR jump. Now, let's discuss the $1.87 billion loss that may intimidate investors. This figure reflects a 302% increase from the previous year, which might trigger panic. However, most of this loss stems from fair value adjustments on liabilities rather than cash outflows. When a company's valuation rises, certain financial liabilities must be marked to market, leading to what appears as a paper loss, not an indication of operational failure. The truth is that this accounting loss is more a sign of success than a setback. It indicates that the company is becoming more valuable, while operational losses are a red flag. Most importantly, the reality is that the bulk of MiniMax's losses are not related to its core operations, which is critical for investors to understand. Now, let's consider what fuels MiniMax's rapid growth. Their product lineup includes M-series large language models and Halo AI for video generation, a competitor to major players like Runway and Picker. The forthcoming M3 series is particularly promising, featuring a sparse attention mechanism designed to cut computational costs, translating to improved profit margins and competitive pricing. Importantly, the technology shows promising signs of self-evolution, with the M2 series already demonstrating early capabilities. If this continues, it could revolutionize AI development economics, essentially allowing MiniMax to automate its own research and development. As for their stock performance, since listing in Hong Kong in January 2026, MiniMax shares have climbed 500%. With the impending inclusion in the Seng Index on June 5, the potential for artificial demand from index funds is considerable, mirroring what we saw with Tesla's rise in the S&P 500. This influx of passive buying could result in more price support and upward momentum for their stock. Now, allow me to present the 3 secrets that link all we have discussed. First, beware the accounting loss trap. Many investors panic at seeing a $1.87 billion loss. However, it's critical to differentiate between fair value losses and true operational setbacks. Second, recognize the impact of index inclusion. The June 5 inclusion event creates a situation where index funds must buy MiniMax shares, irrespective of valuation, thus catalyzing further demand. Lastly, consider the significance of self-evolution. If MiniMax successfully innovates in AI self-improvement, they could gain a critical edge in the AI race, establishing a flywheel effect that enhances their market position. So, what should you do with this information? For aggressive investors, the 500% gain since IPO isn't a ceiling. It could be a floor, given the rapid growth of MiniMax. However, Chinese stocks can be volatile, so invest wisely. Cautious investors might prefer waiting for the M3 launch, ensuring that the technology proves itself first. If you are an index investor, you may already own MiniMax due to its Hang Seng inclusion. The best time to invest was before the announcement. Act wisely as the index funds begin their purchases. As a final thought, I want to know, do you think MiniMax can rise to the challenge against established companies like DeepSeek and Zhipu, or has the 500% gain already captured its potential? Share your thoughts in the comments, and don't forget to like and subscribe for more insights on Chinese AI before the broader market catches up.